My name is Maddi Heckman, and I am the head of real estate and responsible investing content at Markets Group. Today, I have the pleasure of speaking with Clark Coffey, Chief Investment Officer of European Commercial Real Estate Debt at AllianceBernstein. Thank you for joining me today, Clark.
Thank you. Thanks for having me.
So let's start off our conversation with you sharing a bit more about your background and how you came into the real estate debt space.
Sure. I came to Europe. I'm American by background. I came to Europe in 2005, worked for Deutsche Bank in their M&A business. During the financial crisis, I spent the majority of my time working out bad loans in the real estate book across Europe. And that's really where my introduction to real estate and structured finance came from. Once we got out of the global financial crisis, we started new lending at the bank. We saw an emerging trend, which was a real gap in the financing structures in Europe, where a lot of alternative lenders started to be set up to backfill where the banks used to operate and could no longer. I joined one of those firms and built that into a top 10 private debt lender over the next 10 years. After that was sold in 2019, I then decided I should do it again, and so partnered with AllianceBernstein and launched our business in 2020.
So what are your thoughts on the state of the UK and European markets then?
Right. Well, that's a fun one these days. Obviously, we are now in a period where there's much greater uncertainty than we've seen in the recent past. Inflation is a real concern. We're dealing with going from negative rates to a quickly increasing positive rate environment. And I think that's going to have a lot of challenges for Europe, whether you look at the decarbonization trend that's occurring or whether you look at the deglobalization trend, given some of the geopolitical issues in the world today. All of those things translates to our world being slightly more efficient and to growth being slightly harder to achieve. And so I think we're going to go through a period of real stress. I don't know that it reaches distress in Europe. I think we're actually much healthier, both from a commercial perspective, a consumer perspective, and a banking perspective than we were back in 2008. But there will be some hardship ahead and some headaches ahead. And so we're preparing for that.
So commercial real estate accounts for 40% of global carbon emissions. How is ESG playing a role in commercial real estate markets?
Yes, so that's not a great statistic, but it's one that I think the industry is now addressing head on. So we all need to do better. So if you think about whether it's institutional occupiers or institutional capital as investors, there's a level of focus today on sustainability, particularly in Europe, that we've never had before. And so I think that's really healthy. And the point is we are not necessarily overnight going to eliminate or materially reduce that carbon footprint. But incrementally, as we invest in buildings, as we build new buildings, helping, we're a lender, but helping our borrowers and encouraging our borrowers to focus on that reduced carbon footprint and making the buildings more sound from an environmental standpoint is important. I would also highlight that real estate is infrastructure. We don't want to go back to living in caves, and therefore it's necessary. So we are focused on both how do we encourage investors and promote our borrowers to do better from an environmental standpoint, but also a social standpoint.
Now, how are you evaluating ESG through your investment process?
Yeah, so we, from the moment that a transaction comes in the door and we start the initial screen, we run it through initially a high-level questionnaire from an ESG perspective. And so it factors into our selection process from day one. To the extent that we decide to move forward with a transaction, we then go into a much more in-depth analysis and due diligence process around all three components of ESG. That ultimately results in us providing a quantitative score against both the collateral, the borrower, the business plan, the overall investment. And we measure that against the portfolio average and against our targets. And that dictates and reflects whether or not we are positive or negative against an investment.
Can you explain to me the value of investing in debt versus equity in the current market?
Absolutely. So I think investing in debt in today's world it's relatively easy to see the merits and the prospects. And simply put, we generally have a de-risked position as compared to equity. So if an investor wants to buy an asset for 100 and they take a loan of 50, that loan sits senior to the residual 50 of equity. If prices fall, then the equity loses before the debt is impaired. So the debt is insulated by that 50 million of equity. To the extent the value of the asset goes up, then the borrower, the equity, disproportionately benefits from the upside. In a world like we have today, where there's a lot of volatility, a lot of uncertainty, having the value of that 50 million of first loss protection is tremendous. And so that's one of the reasons why we're able to continue to invest actively and deploy capital in these uncertain times and help our borrowers where, as I said earlier, if I was in their seat of an equity investor, it might be much harder to find conviction.
Okay. So given the volatility in the market and kind of that perspective on debt versus equity, what do you see for the future of commercial real estate and the future of commercial real estate debt specifically?
Sure. So I think today is a wonderful time to be an alternative lender. Banks generally operate best in very stable conditions, and we're in an environment where we don't necessarily have that. Further, we're in an environment where there's rising rates. Many banks assess their risk appetite based on interest coverage ratios. And so as base rates increase, those ratios worsen, which just means banks are less effective and probably will reduce liquidity as opposed to increase liquidity. One of the interesting things between the US and Europe is that in Europe, banks historically have absolutely dominated the market. So traditionally, they've been north of 95% of all real estate lending. That started to shift as increased regulation came in post the GFC. And it continues today, whether it's Basel IV or whether it's UK slotting, et cetera. And so in the US, you have a very mature market and a very stable and efficient market when it comes to real estate debt.
Yeah.
In Europe, we have a very opaque and relatively inefficient market, one that is still going through structural change driven by that regulation. So Europe's a great place to be because, frankly, the market opportunity is getting wider. The returns are increasing as base rates increase, and the level of protections and the level of security that we have to protect our positions are materially enhanced in today's world.
Thank you so much, Clark. I really appreciate you taking the time to join me here today.
You're very welcome. Thank you.